Good afternoon, ladies and gentlemen. It's Jesse Colombo, and I'd like to welcome you to our closing bell today with Price Headley from BigTrends. He's going to be discussing his favorite technical analysis techniques. He's going to be showing us bullish and bearish entries with percentage R, acceleration bands, and CCI, along with triple confirmation and multiple time frames with percentage R on a single chart, as well as how to find the next mega trend on long-term charts with acceleration bands, and why CCI is his favorite indicator for options charts. So thank you so much for coming on, Price, and I'm looking forward to your presentation. You can share your screen when you're ready.
Thank you very much, Jesse. All right, I'm going to go ahead and start my slideshow, and I'll be with everybody just momentarily. Glad you could be with us today. Here we go. Let's see. Desktop. All right, can you see that okay? Fantastic. All right, glad to have everybody with us today. Without further ado, I'm going to go ahead and jump right into it. Appreciate that kind intro there, Jesse. And basically, what I want to share with you today, folks, is my top 3 favorite technical analysis techniques. Now, these are techniques you can use across a lot of different vehicles, as Jesse mentioned on the intro. I'm going to be talking about stocks and options, but you can use this with futures, forex, and major ETFs and major market timing as well. We'll look at a little bit of major markets as well. As we get started here, of course, just a reminder that everything that we share with you here is for your information and education only. I will be looking at some live scans, but nothing that I talk about here should be considered a specific buy or sell recommendation on any particular security, and ultimately you know that you are solely responsible for your investment decisions. BigTrends and its staff are not responsible for any trades you choose to make. Not all BigTrends products or services are appropriate for all investors, and BigTrends doesn't provide any personalized financial, tax, or legal advice. We send everything out to our subscribers through both digital access for educational content, and then also for real-time email and text alerts to everybody at the same time. But you have to decide what's right for you and what you want to do with it. So do consult your tax and financial advisor before you make any investment that might impact your unique financial and tax situation. I also have my lead consultant in Chris Sayre listed under Chris S here, so he can also help answer questions through the chat box as I give you my presentation. It'll be fast-paced today, so there's a little something in here for everybody. Out of curiosity, if you've traded options before, I like to get you interactive on the chat box too. Type in a number for how long you may have traded options. If you've never traded them, put 0. If you trade them for a year, put 1. For 5 years, put 5, or what have you, however many years you've been trading them. So we've got a lot of newer folks, which is fine. So I'll keep it simple. But for those that have traded them for a while, I'll also, of course, focus on some things that you can consider as a kind of an intermediate educational tips as well on options. But we want to get the stocks right first. So what we're focusing on today is really zeroing in on the educational piece first. And what I always say is that, even if you've never traded an option, you can use what I'm going to share with you for stocks, for the underlying vehicles that you want to trade. And then you can basically learn about options and learn how to properly leverage. I'm not a big fan of trying to get too aggressive and too leverage. I'd rather use what I would call sensible leverage, where you can manage your risk, get out quickly if it's not working, and move on, but still get the benefits of the leverage working for you when it's right. We'll share with you a little taste of the exploration through the scans process as well. These are our 3 E's of trading: education, exploration, and then it's about execution, having very specific entry and exit rules to get you in and out properly and not get left hanging on any trades. We'll talk about that. We'll jump right into the first of the 3 indicators, acceleration bands. This one's near and dear to my heart. I did invent this one based on, kind of looking at a lot of the different bands that were out there at the time back in the 90s. Like a lot of you, I've started trading options in the early 90s, and I was using your basic trend lines like moving averages. I know a lot of you are familiar with. But a couple of things. One, I noticed that the best stocks, the ones that you really wanted to be on, and especially leverage with options, rarely, if ever, came back to test those same major moving averages. If they came back to test your 50 or your 200-day average, guess what? It was either a slow boat, it didn't have that speed of movement, and that's what we really need when we're trading options, especially buying options, is speed of movement to get the best bang for your buck. But then also too, if it was a slow boat, that might even be good compared to a lot of those that tested those same averages, eventually broke down, eventually went the other way. So we can't afford to be on the wrong side of that trend when that momentum's not there. So looked at a lot of adaptive bands, John Bollinger's Bollinger Bands, Keltner channels, percent above and below a moving average, and a whole lot of other Bomar bands, a lot of other things you may or may not have heard of. But what I found is that most of those bands are based off of volatility. That is, okay, what's the stock's typical standard deviation, how much it's swinging up and down around, say, a classic 20-day moving average. What I feel like a lot of them do not incorporate is the trend component. Okay, so now you want to add up these two, and you can get even more bang for your buck when you're also getting the benefit of trend working for you in addition to the volatility factored in. And so, like a Bollinger Band, acceleration bands usually will encompass about 95% of the market action, the price action for that stock or market. And you say, okay, well, that's what's supposed to happen. It hit me really hard when I was reading, in a good way, when I was reading a book about George Soros, the famed hedge fund manager, where he was talking about how he made $1 billion plus shorting the British pound, broke the Bank of England, as they said in the day in the mid 90s. It was the unexpected, the key emphasis on unexpected, what people don't expect, are those unexpected moves are where he made the most money. And in the technical or statistical lingo, it would be called the fat tails of the distribution. And so, all that means is that, most of the time you may have seen your classic distribution curve. I'm not much of an artist here, so that's not even, we're not going to attempt to call that, a very artistic setting there. But essentially, most of the time we're looking at, that it's saying that the current price right now is of where the price should finish. The more it goes down, it's got a lower probability. The more it goes up, a lower probability. So most of the time it's expecting it's going to stay in a pretty tight range. It turns out that these tails, if I drew a dotted line instead, ends up looking something more like this. And again, pardon my poor graphics there, my own. I did not choose to be an artist for a reason. But basically, this area here with these bigger than expected moves up and down is actually underrepresented in the options pricing model, underrepresented in the market's expectation. In fact, staying flat is probably overrepresented. So you want to be careful about betting that things are just going to stay flat. We've had a flat year, obviously, but bottom line is that we definitely want to take advantage of that. Now we're going to talk about some current examples, but it's always fond memory for me to think about stocks that helped me launch BigTrends, and I launched BigTrends back in late '99, and one of them that helped carry the day as we were getting things rolling was CMGI. This was an internet fund of funds in the day, and what we're looking at in this acceleration band, we got the upper and lower band plotted around a 20-day simple moving average in the middle. So that middle red line's nothing fancy. That's your classic 20-day simple average. The last 20 days closes. And so from this perspective, what you see here is that what we look for is we're looking for one and then two closes in a row above that upper red band for a buy signal, and then it buys the next bars open there. That's the buy signal. Now back in the 90s, as I was developing this and trading this, one close back underneath would be enough to tell me to hop out. So it happened right in here as it closed underneath that band. And what was interesting is that as we headed into Y2K, the start of the new millennium in 2000, a lot of people were actually fearful of that. You can see it wasn't a good reason to be fearful based on the technical action, because CMGI went from the mid 60s up to as high on that move as about 145. And then stopped at about 135 for a little more than a double. And that's just on the stock. The options were even more powerful. And that's in a very short window of time. That's in about 6 weeks or less. And you notice that in this other next example, you get one close above and you say, see, you're about to get knocked back into the trade. But you can see the second close above, there's not a 2 there because I'm going to put an X there. It closed back down under the band. So from this perspective, you see then it went into this choppy sideways to lower range. Just because it ends an uptrend does not mean it has to downtrend. In between these bands is basically what I would consider to be trading range market expectation type of behavior. So I really wasn't trading on the downside the rest of the way there. Had some people tell me on some of my exits on the tech stocks as we had launched, and in early 2000 was telling a lot of people to get out of techs before they crashed. I got featured in Barron's in the fall of 2000 saying, watch out below, it's going to get a lot worse, and a lot of those names crashed even harder. But, basically, one of those situations where, we want to find the window outside of that band. You can see it essentially, if we're just drawing, just this particular phase is the phase where you look back and go, gee, that's the time you really wanted to be in it. You can always have your lucky day or unlucky day where it goes in your favor or goes against you. But what I'm looking for is that persistent trend over a period of days, so that our period of candles or bars, so we can take advantage of that. On the other side of the fence, just to show you another prominent example, Bear Stearns. Always love that name for a brokerage firm, Bear anything. Maybe they should have called themselves Bull Stearns, because their name did fulfill the eventual collapse of the company in March of 2008. This was one of the ones that hit. People always talk about Lehman Brothers now, but Bear Stearns was one of those earlier dominoes that was pretty critical as well, as this firm went from, you can see, an initial 1 and then 2 bars. We're also looking above at the percent R, which we'll talk about in a minute. But 1 and 2 bars below that acceleration band here signaled time to get short on this one. You can see effectively in the neighborhood of about $70 a share. And this is actually an example where, usually I would say to my more aggressive option traders, sell half of your position at a double and try to ride the rest for a bigger gain. We made a mistake and took the whole thing out at a double and thought we could buy it back quickly, and then it gapped down even further, and we left some meaningful profits on that second half of the position on the table, only getting a double on that move. But bottom line is that, hey, it's still about getting on the right side of the market. A friend of mine called me when the stock was $30 on that Friday. I remember it well, March 14th, and he said right near the close, said, this is too good of a bargain here. You can buy the stock at 30, and you can sell the 1 week March 30 calls and get $6 a premium, or about a 20% return if the stock stays flat over the next week. And I said, don't do it. And he said, the bell rang and said, well, I just did it. So I said, why even bother calling me? He was thinking it was too good to be true. Guess what? It was, because the stock then opened at 3.5 the next Monday when JP Morgan made their offer for $2 a share, which they later up to 10. By that point, the damage was done for those March option people. You don't want to try to catch a falling knife. If anything, you want to take advantage of it. Notice percent R on the left will give us some signals, but when I merge it with acceleration bands, there's only a shorter window in there in the first few days of 2008 that we would be interested in. I wouldn't even be interested in the second percent R signal as much, because it's not breaking those bands. Those bands will be your support and your resistance. So those arrows are percent R, which we'll talk about in a minute. But what we're looking at is, I've been critiqued for calling this that I'm just trading the bubbles. And I actually consider that a compliment, because you hear bubbles a lot these days talked about. I think it's talked about the most by those who've missed out. And when people are looking back at a 6.5-year bull market, and they say, gee, how much more can this market really go? This just seems like it's just too big of a bubble. Why would we want to mess with that kind of a market that shows that kind of a bubble situation? Guess what? The acceleration bands indicator, for me, it really allows me to see when the trend is just starting to get going. It's just starting to take off, and the bubble's just starting to inflate. It also tells you when it's starting to burst. Okay, so the old boom bust cycle. Before that, stock sees its true collapse. The key point on this: stocks that bubble up can and tend to and will bubble down or burst down. And so you never want to fall in love with these stocks. You want to trade them both ways. So when you go back and you look at, like I was on CNBC back here in June the 9th, a couple months ago, and I said one of my favorite stocks and markets was the oil refiners. Here's an example of a longer term chart like Valero. I was on Fox News and CNBC back in 04, 05 telling people to buy those oil refiners, especially Valero at the time. And people are saying, no, it's too overdone. You can see it had, when they said it was overdone here at about 20, it went on to double in about another 6 months. Said to buy it again on the pullback back to 30. They said it was going to crash back down. It went from 30 up near 60 over the next 6 months as well. So the point is, looking at it here, you can see we're starting to get going again. It's not outside the purple acceleration band on the monthly chart. We're going to look at some more examples. But I mentioned Valero. I also mentioned Tesoro on this June 9th one. You can see Tesoro is actually even stronger. And this is a very long-term chart. So we're not going to use a monthly chart to trade short-term options, but we're going to use these longer-term trends to find when the wind is at our back, when we've got opportunities. What you'll find in the multiple time frame approach that I teach and preach is the more you get all the time frames lined up from long-term down to short-term on the same direction, it's like riding the big tide in and riding the little waves in and even getting the little ripples pushing you into shore. It's going to make it for a much smoother, easier ride than if you're swimming and fighting against that current going when the tide's going out. You're trying to get to shore. So the bottom line is that, from this perspective, we really want to take advantage of that. And you can see it's not just the acceleration bands, but also the percent R, which we'll get to next. That really helps me to see these unusual trends and take advantage of them. Those are not recommendations, just showing you examples. So some of the key lessons in looking back across a lot of situations of what worked and what didn't is that acceleration bands are usually driven by growth stocks and growth sectors, and the ETFs, of course, being the big exchange-traded fund sectors. Industries like technology, biotech, communications, medical, healthcare, a lot of those. Usually earnings are growing fast, okay? So we're looking for, good earnings growth, a lot of times moving up into the, the high double digits, if not pushing to the near the triple digits. And they're usually beating the typical Wall Street consensus estimates fairly handily. When we also look at, the general consensus opinion in the media, there's usually some amount of media debate or skepticism on those uptrending stocks that keeps me bullish on those type of stocks. A great example of that would be Tesla. Tesla was one. I was actually at a Vegas expo where Fausto was as well back here in the fall of 13. We were talking about this one and saying, look at when Tesla first broke out. One and then two closes above that purple band right there happened at $97. You say, oh gee, Price, you're really late. Stock was actually down here $28 just 6 months ago. My point always, especially when you're getting to options, is you want stocks that can move. By the way, I've plotted just to compare in this example, the light blue line is a 20-day Bollinger, 20-month actually Bollinger Band. See, the Bollinger Band tends to race to catch up. The acceleration band in purple is a lot more stable. This is a trailing moving average in the yellow, just to give you a taste of it. Where's Tesla right now? It's in a no man's land where it's back into that trading range. It just hit its upper Bollinger Band. It's nowhere near what I would consider to be a big breakout on the acceleration phase. But I was telling people right there when it pulled back to the acceleration band, it's about 116. Everything was showing me that we had a pretty good pullback to support. I was talking about 120 when I was talking about it, and everybody was like, "Oh, I don't know. It looks like it's made a major top. If it's just at 194, you're buying it too low. It's already breaking down here at 120." And I said, "No, it's just a classic retest, a classic retracement." And it was on bad news. The news was that the National Highway Transportation Safety Board was investigating the company because of about 3 car fires that had happened because of their electric engines, and they'd had like 3 car fires. Guess what? Probably a lot more gas and oil-driven engines having a lot more car fires than those few that Tesla was having over that sample of cars. But the reality was, okay, that there's always a reason, quote unquote, why a stock will pull back. It's a great opportunity from 120. You see it popped to over 240 just over the next 3.5 months. So the point of that is that there's opportunities within strong trends, and a lot of times you get left on the sidelines, and you're wondering how do you take advantage of this? How do you make it something where you know what you're looking for? A lot of these stocks, you'll notice, are breaking out to new highs, and if I'm buying them on a retracement, they're not too long of a pullback. It's like quick little pullbacks are fine. extended pullbacks where it's really rolling over for a long period of time do not interest me to stay with the stock. In our studies, we found that over 80% of the leaders over the next 12 months were usually within 15% of their highs when the upside breakout began. So the idea that you are looking for quote unquote value is a mistake from a trading and even investing perspective. Leaders stay leaders longer than you would expect. You've seen Apple in the last, in the last decade now, since about 2004. There's just so many examples where, let me zoom that in, you can see that as well. You can see here that I've maxed out my screen there for you, Clement. It's the best I can do on my end, but see what you can do on yours. And you can see actually Apple is going through a monthly, what we call a percent R retest, even though it's getting a little bit steep here on some of these trailing averages. That's a little bit of a concern, but it had a nice little acceleration phase from that signal at 100. It popped up to, as you saw, about 134. Nice leadership when the rest of the market wasn't doing too much. But you can see going back in time, some really nice acceleration phases, 2010 to late 2012, before the iPhone 5 launched, that kind of fizzled. And then, of course, there's another one back there, 04, 05, 06, 07, before the 08 crisis hit. Apple had some really nice moves. So the point is, okay, what's now for Apple? I mean, we'll see, but right now it looks like it may actually, give a little bit of an exit on the acceleration criteria here, breaking this trailing yellow average. If it does that at the end of the month, that's about 117 and 3/4 right now. I wait for the close at the month to make that an official stance. So we'll get to shorter term trades. I know you want to look at some short term intraday charts too, but I want to kind of just give you some of this bigger picture perspective. Another example with the acceleration bands, in this case in green, 1 and then 2 closes above there at that bar's close, that would be a buy for Google. And Google, interestingly enough, has had some interesting news here about how they're splitting up their kind of core business into this company internally called Alphabet versus their other, actually, I guess Alphabet's the newer ventures versus the core business that's driving 98% of their revenue. So shows you the co-founders looking to kind of get into new areas and not be maybe just hamstrung managing the slower growth businesses for Google. But regardless, stock popped on the news today from last night's news heading overnight. But you can see this had a really nice surge. We don't just use a close back into the band. We see right here it closed back in the band, but that's not enough to get us out these days. I didn't show it on here, but we'd have a trailing average here that would violate on the close right there and get you out. After that, it's basically anybody's guess. I call that the no man's land. After that, it's your guess is as good as mine if it's going to be up or down in a trading range. It's like that's like playing coin flips. We don't really want to play coin flips. We want to play games where we have a much more meaningful edge. So from that perspective, you can see here that the buy, and notice that in comparison to Bollinger, it races and it actually stays. Google stayed outside of the upper Bollinger band for about 4 or 5 sessions, and then you see it just using the Bollinger Band, you would have hopped out right there. That would have been far too premature to get out of Google before a lot more move to come. You see, that would only caught about the first 20 points or 30 points of the move. When it ended up making about a 150-point move, you would have left about the remaining 80% of the move on the table. So, our job as traders is to take advantage of that, and we'll show you some more opportunities how you can get in and get out and then move on to uh, other opportunities. Now, percent range is a second key tool I wanted to share with you some overview on, and we'll tell you about later about how you can get actually all of my in-depth many hours of training on these top 3 indicators. But I wanted to introduce them to you if you're new to trading. Some of you said you're new to options. I'm also going to talk in a little bit about CCI as my favorite, the commodity channel index is my favorite indicator when I'm looking at the option itself. So when we get down into the nitty gritty of options, after we find the stocks that we like, CCI can help filter a lot of that. But the percent range, Larry Williams developed it. And at percent R, we call it. But Larry Williams developed it to typically find overbought and oversold markets. And, my opinion is that, actually what I've seen is that percent R overbought stocks will stay overbought. Like I told you before, the strongest trends occur when the stock is at or near its recent highs. Weakest trends occur when it's down near or at its latest lows. Now, in this case, Larry Williams uses a shorter setting which I find leads to a lot of up and down type of action like this. You'll see on the chart what percent R looks like in a minute, but basically I'm looking for something where percent R is going to stay overbought or stay oversold, and we can take advantage of that. So I use a little bit longer setting in my big trends approach to the percent R indicator. Now, you see in the classic Williams settings on most of your platforms, you'll see it be a negative number from 0 down to minus 100. So it's usually some kind of a negative number reading. And most of the typical percent R users are using it to signal reversals, buying overbought, or I should say buying oversold and selling overbought. I found in my testing that actually the opposite tends to play out a lot better, that actually you're better off if you followed staying with the big signals to the upside and the downside. When it goes overbought, stays overbought, you've got a real opportunity there to really leverage that on the way up and on the way down. Now I'm going to show you something too here. Let me actually show you this in just a minute here on the Dow. The Dow is a good example of, when we go in and we look at the percent R indicator, for example, going back in this case some 90 years. Okay, this is pretty interesting. Let me show you this real quick. If I was just going back on the Dow chart on percent R, you can see this bull market that we're in right now, officially on a percent R basis. Just give you a quick taste of this. When we go overbought, I use a positive scale from 0 to plus 100, what I call the grade school scale. If it goes overbought and then it keeps going up, most people would say when it goes overbought, you should be selling it. Guess what? That would have been a bad time to sell the market at the end of 2010, wouldn't it? Because you can see it was actually about to break out at the start of 2011. And what I say is if it closes above that overbought high in the future bar, that's a new buy signal. Now, we did go through the little short-term summer of 2011 debt ratings crisis where some of the big ratings agencies were downgrading U.S. debt, and that caused a short-term pullback. But that leads to what I call a retest. When we pull back under that overbought threshold, if it doesn't close below that low, which on the Dow was 10,597, traded below there, didn't close below there the next month, and then actually led to the biggest one-day month gain in October 2011 since January of 1987. So when we get these what I call retests, the snapback, the flip back up, kind of like holding a some type of a balloon or inflatable toy underneath the water in the pool. You get it underneath there and you lose a little bit of control of it and it just snaps right back up, right? So the idea being that once these little tests happen, the bears can't take control of the market, the bulls still have the ball, and then we flip back up. Look at where we are right now. The reason I point this chart out on the Dow right now, everybody is wringing their hands about how terrible the market looks, how we're breaking down, how we are below the 200-day, at least during the month right now. The monthly chart shows we would wait and see what happens on this one relative to this level about 17,550. We're about 150 points below it as I speak. But again, it's August 11th. We've got some more time before this actually is official at the end of the month of August. What I've seen happen time and again, you saw it in October, we got a big snap below there and then all the way snapping back up. We went from 15,855 low in October this past year to up to 17,390. That was like a 1,500 point Dow flip by the end of October. The bulls held the ball at the end of the month. But you can see we are on that retest. This means this is a key month's low being put in place so far, 17,279, although the month is of course not over. I'm still bullish when I look at that chart. Why? Because when I go back and I test this data, this is on TradeStation, and again, I wasn't around in 1925, so these are going back historically and showing you how would you have done if you were able to buy and sell 100 shares of the Dow Industrials, which you can't do. So this is purely just a testing exercise only, going back and hypothetically saying if you bought, if you sold when we got buy and sell signals, how would you have done? What's fascinating to me, that over the last 90 years, going back to the roaring 20s, the market overall has been in a monster bull trend, right? What's interesting about this is, look, on the bullish signals, you'd be right 53% of the time, 8 wins out of 15 trades. This is a very long-term system, obviously. What's even more impressive is out of the short signals, there's only been 4, and you'd be 3 out of 4 correct. So when you look at that and you look at the equity curve of that buildup, of course, the dollar gain in the Dow has been the greatest since the 80s and 90s all the way up here, that big signal at the beginning of the 90s. But even before that, we had good looking equity curves going back here in time. And so you can see, for example, a good little history lesson for you. This is pretty interesting. This signal does not actually show. This is back to 1929, the crash of 1929 that everybody talks about. You know, you had the Roaring 20s. There's your percent R big uptrend. Technically, that first drop was actually a retest, kind of like the 87 crash was. That was, and the 87 crash held that support and rallied off of there, and the bull market continued. Despite everybody saying the next Great Depression was going to hit after the 87 crash, they were wrong. The trend held. Well, in this case, look at what happens. We started to bounce back. We were holding and bouncing, and then in late 1930, you can see what happened. We started to go oversold, went oversold here, and then broke down under about 200 on the Dow. Obviously, this is in 1930s money, but you can see breaking down under 200 on the Dow. This is now a bearish signal because we're staying oversold, and we went from just over 200, just under it actually on the signal, down to a low of about 40 and a half. 40.56 is the low of the last 90 years on the Dow. That's pretty hard to believe, right? But you can see, and officially when this thing tested back up, then it said, okay, when it tests that high, that should hold at 75 on the Dow. It doesn't, and would tell you to get out at 88. So still from just under 200 to 88, that'd be a 50% haircut. That's what was causing the Great Depression, was that next year collapse after the 29 crash, in my opinion. I think it's pretty clear when you look at that especially when you compare it to the 87 period, there's 87. We're in a big uptrend before 87. You get this hard down move, but in a long-term context, that's just a key test. It's just the first time we're pulling back underneath there, and that low held. We didn't break it. We went another couple years before we finally got a slight violation signal in this fall of 1990 after Saddam Hussein invaded Kuwait. Okay, and then guess what? It got you right back on the wagon in 91 a few months later, and that signal lasted for most of the 90s. You can see just how powerful riding a big uptrend is. That's the beauty of this whole big trends approach, is when you're right, you want to get the most out of your ideas, and if you miss a buy signal, you could be buying back in on these retest points along the way. So the bottom line is that you get opportunities to buy the dips within an uptrend, and if you're wrong, you get right back out very quickly. So it's okay to be wrong, just don't be wrong for long. In comparison, when you're right, you get a lot out of these big upside scenarios. When you're wrong, you get out quickly. So cutting your losses quickly, letting your winners run. You'll read that phrase in every trading textbook. When I was getting started in trading, graduated from Duke University in '89, couldn't wait to get into trading. Every textbook told me that was the secret to trading success, but none of them told me how to do it. So, I had to cut my own teeth and run these through these systems and find which systems do the best job of getting you out quickly when it's not working, and letting it run when it is. So this is a very unconventional approach to the words overbought and oversold. You can see from the examples I just showed you, overbought is very powerfully good if it stays overbought. Okay, so this is how we would look at it. Now the conventional versus percent R versus the big trends settings, you can see like this is a chart of GE. GE broke out here and then closed above there in the very next bar to give you the first buy signal, even before the acceleration band breakout. And what I think is powerful is that your classic, what I call retest, happens is it just dips down right here. Now, if you're using the shorter settings, you could have had a couple of other retests before, but then that one would have told you to hop out too early, about a day before, and then you probably would have gotten faked out the next day when it broke down. So that would have been something you would not want to have been faked out by. This would be a re-entry signal on the big trends percent R on that dip, that retest. And you can see you would catch another nice run. Now, if you bought the next retest, here's what happens sometimes. You buy the next retest, and you see it's starting to hold. Looks like it's starting to go back up. And then you see after a few days up, it kind of just flattens out. And then you see what's going to happen. It's going to eventually tell you you can't afford to hang around there anymore. You got to hop out. So, even if it's not working, you'll know when you get a violation on that indicator. Okay, on the other side, one of the other things that we require in this whole principle of a lot of these indicators that I teach is what I call confirmation. That if you're just trying to catch that very first turn, that very first potential uptick after a pullback move, you can a lot of times get yourself faked out, whipsawed we call it. So you get whipped in, whipped out, and then you end up kind of not only getting frustrated that you're losing some money, but more importantly, it starts frustrating you psychologically. So you know from this perspective, we're looking at how do we do what we call the setup, is where a lot of other traders will kind of be rushing in. We look for then that follow through confirmation to tell us that indeed we've got an opportunity to really get the validation that in essence the stock is proving it to us. It's proving that it wants to go that direction. There's nothing that gives you a 100% guarantee. Some of those are going to not work, but like I showed you before, the ones that work can be very powerful. The ones that don't, you hop out, move on. Now, that's the big difference, is that temptation that a lot of you feel to rush in when you see what you think is a turn gets a lot of traders whipsawed in and out and gets them very frustrated. So the confirmation for us is very, very powerful stuff. Now, the criteria, we teach all the criteria for how to get these setups, these very specific rules, and then go from there. This is a great example, not just of a breakout in this stock, but how many times you could have gotten back on the wagon. The train leaves the station the first time, and then if you miss that first chance to hop on, you still get reentry points as the train pauses at the next stop before it goes on. So you could just jump on at the next stop, and then if it's a really good trend, it's going to keep going. If it's not, you hop right back off. Okay, so you see, here's an example where breaking out confirmed on that first buy arrow. Okay, but look at how many retest points you get every time we come back on that percent R test underneath there. You could be buying those retracements. If it closes underneath that low in mid-March, you would hop back out. The next one that happens there on the 30th, you see it looks like it trades below it a couple days later, but it does not close below it. That's the key. A lot of traders get whipsawed by intra-bar movements. We say wait for the close. So all these key tests give you chances back on the wagon here, getting lots of those spots. You can see here lots of those arrows right off of those little lows, and then boom, takes off yet again here. And so this is kind of also like riding the escalator up. You can see if you connect those dots, essentially it would basically say that you keep your stop in place until you get your next key reset point. So it's almost like a little escalator ride up when it's working. Okay, so this one, you see another one coming right there, and then you see there's going to be another one coming, in this case right in this area here, right off of that one, and then it's violated right there. So it's telling you, okay, now you got to hop off. The up escalator is not holding that level, and now it's time to hop back off. The beauty of this approach is it will keep you then out until you get a reconfirmation. You see it tried to break out a couple of days later, didn't follow through, but then it did close just above that last key high, not by much, but by enough. And then look, it gave you another reset point right off of that low. Would have flushed those intraday people out, and it traded below their intraday, but it managed to hold at the close. And then that one, you see, by the time it then hit its next retest, it's going to stop you out a couple of days later. Okay, but you at least caught that first move. And you say, well, what about the acceleration bands? Well, this is a little slower trend. So what I would tend to do is I would say when you hit your upper acceleration band, you should say, thank you very much, check mark, take some profits. Doesn't mean you have to take your whole position off, but you could certainly take at least half of your position off into that band resistance if you're trading it within that kind of just slower uptrending channel. Buying the retest is important in that case, because you definitely are finding more of a slow, steady trends. You don't want to chase a breakout in those type of stocks. This was ICE, Intercontinental Exchange, which now owns the NYSE. Their stock did so well, they were able to buy out the New York Stock Exchange. Okay, on the downside, you see the other side of the equation. This was Family Dollar Stores, FDO, and you can see, so now we're going oversold here right after March 7th, right about this point right there, and then we're closing below it right there. So at the close, you're getting your confirmation. Notice this is not getting the acceleration bands yet, but you can see it's getting close to that. The second signal is even more powerful. But what I would point out to you is that now when you test the oversold threshold here, they're usually going to happen on kind of a sharp bounce. In this case, right off of that high right there, that would give you another spot to bet that resistance would hold. If it closes above that high from about March the 24th, that would be a time where you would say, okay, you know what? You need to be out if it closes above there. So anywhere above that high line there, which is basically would hold as your retest until this next one hits. This one was a little bit violent. That retest and then the exit's happening here. So that was pretty rough. A lot of times what we would say is like when you get a gap like this even and you're in a short, we'll probably take part of our profits even as it first gaps down, because you never know if a gap's going to continue, and a lot of times taking profits as the market makes it available to you is a good idea. What's also powerful, look at what happens at the end of June on this chart. See how it's trying to go over bot? You say, see, that one didn't work because it's starting to break out of that upper acceleration band. But notice it did not confirm above that high. So in our view, we would not say we would not take that trade because it never confirmed. So it kept you out of trouble. And then you see the percent R tells you to hop on even before the acceleration. One way you could say, well, how do you merge those concepts? You could say, well, you could always put on part of your capital. It actually closed just below there, right there. And then if you waited for the 1 and the 2 on the acceleration, you could put more of your trade on into that confirmed acceleration breakdown there and ride it on down. Near a retest there in the middle of August. Intraday it was there, it just didn't close there. And then trails on down. Notice how it obeys also the acceleration band nicely. And then as we come back inside of it and then violate it, time to hop out and move on to greener pastures. Okay, so this will help you to know when to trade and when not to trade. Now, one of the things that I've done is I've set up my top 3 boot camp, these top 3 indicators really to go. I know I can only go through so much in an hour. And so what I did is I set up to where I really wanted you to understand all the ins and outs, all the indicator settings of these top 3 systems, the acceleration bands, the percent R, and the CCI, which I'm going to share with you next, Commodity Channel Index. And these are all tweaked based on my testing of what gives me the best results. So again, past performance is no guarantee of future success, but I think it sure is an indicator of if you've got something that can guide you effectively through the heat of battle, through the ups and downs in the market, through a lot of different market conditions. So from my perspective, we need to learn these. So whether you believe we're going to have a bull market to continue, a bear market to come, or a lot of chop, it'll show you not when to trade the trend, and also tell you when to stay away in the chop. So when you look at, let's find a couple of shorter term indicators for a second, and that's at bigtrends.com/top3 bootcamp that Chris is posting for folks. I appreciate the help there, Chris. So let's go down to look for a second at, and these are all, by the way, digital on-demand courses now. We've made it to where you get instant access. So say that you're looking. This is an example actually of GoPro today. GoPro, had been trying to trend up here on the daily chart, but look at how nice of a trend it was on the intraday time frames. So for those of you who like to look for more of a quick trade over 1 or 2 sessions here, you can see GoPro today, after a nice little trend up the prior couple of sessions, it rolled over. Look at what it's doing here on the very short-term charts. It's starting to break down on the acceleration bands, 1 and 2 closes. The percent R in this case was a little bit behind. There was the first setup on percent R, and when it closed underneath that low around 62 2/3 right there, it was telling you to go ahead and hop on board a new short here, 62.66. Now the stock trended all the way down intraday to almost 58 and a quarter for about 4+ point move on the downside. You see how well it stayed below the percent R and the acceleration bands. And now what I would do is I would say, just go back and study these and say, okay, if you're new to options, a lot of you said you were, what would you trade as an option if I was looking at GoPro right here for more of a quick trade? You could trade the weekly options. Sometimes the weekly options don't have a lot of liquidity. That's something you have to pay attention to and see what fits for the type of trade you want to do here. But let's just look at GoPro for a second, just for purely an educational exercise. So if you're looking at GoPro, let's pull up. This is on the options station Pro within the there it is. Okay, within TradeStation. I don't recommend trying to hit the home run on the out of the money options, even though in a case like this you would have made more because it was a really nice steady move. Sometimes they're big moves in your favor, sometimes they're slow, and sometimes they go against you. You can see the problem with GoPro, of course, is it's still kind of illiquid on, like, my ideal strike would have probably been about the 65 strike. back when the stock was trading at about $62. You can see things like delta. We look at very high delta options when we're trading them short term over a day or two. Even for swing trading, we're still looking for things that are going to move fairly well. So something that was about 3 points in the money, you can see had a delta between 75 and 83%, meaning that it's going to move when the stock moves down a point. This put option is going to go up. That's why the negative sign is there for an inverse relationship of a put. Say it's an 80 delta on average. That means the stock drops a point. Your option goes up 80% of that. So the option goes up from say 3.5 to say 430, up that $80 a contract on a 1 point move down the stock. So what I want to look at is I want to look for a second. I might even also look at the monthly options, which might have even more liquidity, which expire next week, at the end of next week. And you can see in this case, yeah, there was still some activity there. They probably weren't as active as I would have liked there either. And the spreads are probably a touch wider than I would like as well. But part of what we're looking for is things that are active enough that we can definitely go in and track them on an options chart as well. Okay, so you see the really big activity here. You see this is some pretty big volumes here. 5,500 contracts traded on the 61 put. That doesn't mean I would have traded that one earlier, but you know what? It probably means that the option chart looks pretty interesting when you go in and study it here. And so let's take a peek at it here real quick. And there we go. Let's shrink that. So for example, we didn't trade this one, but just for example, I'd just like to go back and teach and study and learn from any of these, because 61 would be an out of the money put when we were getting the breakdown. I like to put my cursor where we got the breakdown signal at 62.6. Now, just because we're not going to trade the 61 put doesn't mean we can't look at how the options chart happens to look. Now you can see in this case, sometimes that's where we're getting our initial sell. Notice %R and CCI, the tools that I'm going to teach you about here now in CCI, we're not confirming until much later in the day, 1 and then 2 above on the CCI. Didn't confirm until about $2 on the option. The option finished bid 252. So it still would have made you a little bit of money, but it would have missed the core of that move. The one that I was saying I would have probably liked better was something like a 65 put. The problem is it's just not trading actively enough. Its official %R signal happened when we broke out over 309 at 355, and the option did go from 355 to 650, so it got a near double even in that bit of a window. So you can go in, you can look at each of those different potential options, and the problem again is that there's just not enough data on some of these weekly options. So we might go look at the monthly options, go look for a second at the 65 put. You see, okay, now we got a little bit more data, but again, because it's not trading as actively, it's not picking it up fast enough on that particular example. The 60 put, which we wouldn't trade but might be useful to tell us, is this thing strong enough to get a breakout? You can see in this case, this one did have a lot more trading activity. It traded a total of about 700 contracts and has traded a lot out there. Notice %R broke out. The high was $1.11. Once it closed above there at $1.15, yeah, it was telling you at $1.12 to $1.20 it could be worth getting into. And that one did go on to more than double in that move. So we're looking for those periods where it's breaking out. Now the CCI I was mentioning earlier is one I use to really help confirm indications of a breakout. So the CCI, you'll notice a lot of the time on this particular one, it couldn't get above its overbought threshold. When it did, it never could follow through. So it was only late today that it broke out and confirmed. And so what that tells you is there could still be some legs on GoPro on the put side, on the downside for the stock. Because if you buy a put, of course, you're betting that the stock is going to go down. So from this perspective, it's not a recommendation, but it's saying, yes, it is relatively weak. And that means that thus the put option is getting strong enough to make it trend. And so, when we talked about Apple. Apple is one of the most actively traded options out there behind maybe the spiders, the SPY. And so if I look at a vehicle like Apple, for example, which of course has been very volatile in both directions, but you can see going back here, more of the action, not just on %R, but also on the CCI, was on the downside. So if I was looking back here in late July to early August through these downtrending phases, you can see it did break out briefly yesterday, although we'd certainly want to get what we call the multiple time frame mentality in place. Last night I mentioned to some of my subscribers that this little test yesterday was a bearish retest on the daily chart. So we're pointing out that, yeah, we thought Apple had some downside potential to go. And so the question is, if you're buying a put option, looking at that daily, knowing that The 15-minute went bear confirmed this morning here at about 116.36 at 11:15. I'd probably be looking at something like a 120 put in the August monthly options that have about a week left. So let's just look at that option chart for a second. Option charts are something I've been preaching for about 15 years. I launched BigTrends 16 years ago, and the technology for a while didn't exist. I used to keep my own option charts, and now a lot of the big brokers keep them as well for you. So you can see this option chart's probably not quite as ideal as I would usually like. The daily chart looks pretty good. It shows the CCI breakout right here and above that overbought threshold, and then it did break out. And then on the big bounce in Apple yesterday where everybody's talking about, it's about time Apple bounced. So guess what? It was just showing that that was what we call a retest on the CCI. Kind of like it's just stuck in a trading range here, which it is. The CCI is telling you that off of that low yesterday around $2 on this 120 put was a pretty good chance to buy a relative low entry point, and you see it went from 2 up to about $7 today. So that's a pretty big move, and it still would be saying on that bigger picture that it has that potential. The problem is on the hourly chart, we're not there. Right now, the hourly chart showed you a breakout back at the end of July, beginning of August. I was just talking about it. Once it got over this high, which was a 238, it did it right there at 241. And so then we bumped around here, got as low as $1.72. So sometimes you'll see you might have to endure up to maybe a 20% pullback in your option price and still be able to stay with your trade. That happens, but that's a pretty reasonable first trailing stop. And then that thing went from the 2.5 range up to as high as about almost $9 there, 9.15. So when it broke off that retest, then you were going to have to hop out. There's another retest, and that one is going to break under 558 at 5.25. Then you got to be gone. The rest of your position, you got to say bye bye. So we like to sell usually half of the double, try to trail the rest up to a potentially bigger gain. And some of my other alert services were even more conservative. We might look for 20 or 30%, followed by maybe 50%. It just depends on kind of what your risk versus reward ratios are and how much time you buy. So right now, you see it just testing back up into that overbought threshold, not confirming, so we're not quite there on the hourly chart, and it just barely confirmed late today on the 15-minute chart. Part of what I do, and this is where I want to kind of put some of these pieces together for you, that's CCI with the option charts. Part of what I do, a big part of it, is taking the training that I'm giving you right here today to give you a starting kind of a jump start point. I mentioned those refiners. Well, guess what? They were strong again today, even though the market got crushed. So you're looking for names that are bucking the overall trend on the downside if you're looking for potential bull plays. And then you're also looking for names that can benefit you on the downside as well. So what we would look for, obviously, is TSO and Valero are obviously two very strong stocks. AXP, of course, got that lift on Friday on the news that a big hedge fund Value Act was going to buy $1 billion, or was already buying $1 billion stake in the company, just looking at it as a long-term value play. So it popped up on that news. These green marks show us what we call bull confirmations. Oh, by the way, bonds, TLT, we've been talking about them for the last couple of weeks with subscribers saying, even though they are below their 200-day until today, it started to break above that long-term moving average here at the close today. We've been on a % buy for the bond market here since confirmed 723, buying the open on 724 a couple weeks ago. You see we've had a couple of retests where you could have bought those dips. You could have also said, you know what, if you wanted to, say you were looking at the option charts, you could have been looking at something like the monthly options in August and looking at something like a 120 strike call, and you'll notice that after not looking that great, they really started to perk up over the last several sessions. And you see they're a little choppier on the 15 and hourly chart. So we usually wouldn't trade a bond option, but it is showing you that that is a meaningful breakout that's worth watching. See if we can get some extension past that 200-day. Gold, in comparison, speaking of the major markets, has gone the other direction. It's bounced in the last 4 sessions. But, when we look at gold here, we'd say, you know what, that was a retest yesterday. That high was 106.27. Look at where it closed today. After being above there, it closed a penny under that high at 106.26, and that's a CCI test as well. Technically, gold is still in a downtrend, even though it looks like it's trying to pop up here. You see the last sell signal on the %R, which is happening right in front of the breakdown in the acceleration bands, was happening there at 111.66 on its way down to about 103.5. So down about 8 points on GLD. Again, back then, if you were looking at that daily chart breakdown, you're looking at, say, the August, say, 112 puts, for example. You see, look at the breakout on the percent R option chart, close above that 315 level. Didn't quite happen there, so you'd have to wait till that one at $4. But even from $4, it went from 4 to 870. Now it's actually showing, yeah, the option chart's a little weaker than I would like, so I would actually not be betting on that bear retest for GLD having to hold now that the option chart's lost it a little bit here. So it tells me to wait. Wait till these other things sync up. That's a big part of the multiple time frame confirmations. Look at when you've got the daily chart breaking in your favor, you get the hourly chart moving up and for the put, and the 15-minute chart, all three time frames. This is like three rivers all flowing together into one much more powerful river. Okay, so that's really how this stuff works. So part of what we'll do is we'll take those radar screens and we'll go in and we'll find those and we'll call those out and show people how to really benefit from those. So, the whole scanning process, through everything that I teach you off of the bootcamp course is set so that you can go use this information to find new opportunities, or you can contact us and we can help you with alert services to pick up how to benefit from that. But clearly, the first thing I want you to do is make sure that you master these indicators, these system trading rules, and ultimately then look at the top trades that I place so that you can then know how to do that. I'll also give you some guidelines on the proper option strategies, how much delta you should be buying, how much time you should buy, depending on what type of trader you are, all that kind of stuff. There's something in there for everybody, and that's really what we're after, is to help really train you about the best ways to leverage both the knowledge and still, obviously have you focused on first and foremost results. I don't want you to just be hyperactive for activity's sake. I want you to really make sure that you're leveraging the knowledge into the best of the best opportunities. If there's nothing there, I wait. I'm very much about being patient, and then from there really focusing on, okay, what's the next best of best opportunity. So as we said, where you want to go, and I'll show you how you can get started here real quick. You go to bigtrends.com/top3 bootcamp. And let me drag that page over real quick so you can see that. And on this page, bigtrends.com/top3 bootcamp, thanks, Chris, got it posted again there for you. You can click on it as we're done here in a few minutes. You can also ask any questions if you have a few for me before we wrap up in a few minutes. So let me just show you this real quick, and then I'll answer a few questions. So you go to that page, and this is all three indicators. This is knowledge that I've literally picked up over 25 years of trading. I'm offering that to you in a 3-indicator class on the top 3 indicators boot camp. Usually would be in and of itself a $299 price point off of our website. As part of Fosso's group here, I'm giving it to you for 2/3 off, just 99 bucks today. So all you need to do when you go to that page, you hit the orange add to cart button, and that'll pop that into your cart. Now the other thing we're also, and you see it's got the top 3, the percent R is a full session, so is the acceleration bands, and so is the commodity channel index. And each of those was guaranteed to be an hour. They end up going about an hour and a half a piece. So you're talking about something like 4.5, pushing 5 hours worth of content here. Okay, the beauty of this is that we give you that, and then if you want, you can also get my other what we call the next 3 indicators, which is then going into the DMI and ADX. If you probably heard about some of those, we teach you how to use all that, and then the unique approach that I use called DMI difference, showing you not just when to get in, but also when a move gets too extended, when to hop out. And then the efficiency ratio that I developed off of a speech I saw Perry Kaufman give some 20 years ago. It's been a very steady, persistent trend indicator. And then the last 3 kind of brings together the market timing through tools like the volatility index, VIX, the trend and elements for the market, and the put-call ratio, the MACD indicator using what we call momentum divergence with that, and also percent above the moving average. In that session, I detailed a stock, Bluebird Bio, BLUE, where I told people how to buy this because of this very unusual signal that we got there a little bit earlier this year. And I showed people I was buying it and ended up making a nice double over the next about week and a half on that BLUE stock. Okay, that's another great example where we show you, we literally put our money where our mouth is, in the sense of, okay, we were calling out. Now it's not a signal, by the way, so don't trade it now. It's starting to roll over with some of these other aggressive growth stocks getting knocked a little bit, but we actually called it out back in March. And so I said, look, you don't have to be early with these. This was a new retest. It was a new buy opportunity with that particular percent above the 200-day. I told students there I was going to buy the 100 calls the next morning. I did. As it opened even down below my level intraday. You don't want to panic on your intrabar or intra-candle analysis. You want to focus on really the true trends. You see from there, it flipped right back up. If anything, again, it flipped up so quickly, you got the quick double and said, thank you very much. And you see at April options, it ended up, I could have made a little bit more in April, but you can see if you stretch out, you can get multiple chances to come back on multiple retests, like I showed you with that ICE example. And even if you get knocked out, you can hop right back on the wagon here and catch another piece of the pie, another opportunity. How many times have you looked back on something where you said, oh, I thought it was going to go, but then I missed the trade, and then I felt like a dummy for being late on it, so then I just didn't trade it, and then you saw later that you felt like even more of a dummy when it didn't, when you could have made even more money on it if you just acted again when you took another look. So we teach you the right points to take action. I appreciate the kind words, Pete. Thank you. It's my pleasure. We teach you the right points to take action, those what I call inflection points on the trend. So whichever way you want to go, if you want to get all of those courses, you can add the other two indicator boot camps all in for just $199 for all 10 sessions, because we give you a bonus session on that one as well, total of 10 for 199 bucks. Or you can just get started with the 3 for $99. If you had to add the cart, that'll be the 3. When you left click on that, you'll see it pop it into your shopping cart off of the BigTrends shopping cart, and you can see you get your option there also to add the other two classes for more than 10 hours of training, all in for just 199 bucks. Or as I said, more than 4 hours of training if you just want to go with the top 3 that I was sharing with you here today for just the 99 bucks. Whichever way you want to go is fine, but my big goal is whichever way you want to go, just make a choice and get started learning these BigTrends methods. I think you'll be blown away with how powerful they are, how they can really get your perspective and your mindset pointed to the next opportunity rather than just being stuck in the chop mode where you're leaving a lot of the big winners to other traders like myself. So you can start doing this as well. So you can see it puts you on our secure page here, HTTPS, and you get your key information in bold, which is needed for the credit card processor to process the transaction. So get that information in. Through email, we send you your members access and login information. And the other thing I didn't mention is you have lifetime access to this training material. You can watch it as many times as you want. The only thing I ask is that you just keep it for your benefit and your family's benefit. We do track those IPs, so just make sure you're keeping it for your own benefit, and your family can watch it too. But bottom line is that from this perspective, you get your credit card information in here. We take all the major credit cards. And Chris has been on. If he's helped you to get started, do give him credit, or you can just click that you saw it in the webinar, either way. And terms and conditions are spelled out below. Once you review those, we are very transparent. We show you on that link. You can copy it into a separate browser, and I encourage you to review it. It's very clear about how we do business and have done business since we launched 16 years ago in 1999. So we even spell out some other things. There's nothing auto-renew about this. This is a one-time investment, $99 for the top 3 course, or if you get all 10 of the sessions for $199, both of them are one-time investments. You get lifetime access. Hit the green submit order button, and you'll get that. Some of your credit card processes properly, you'll get that stuff automatically sent out to you in your email box. Now, if for any reason you have trouble with it, Chris is standing by to help answer questions. You can email us, clientcare@bigtrends.com, or you can give us a call at 1-800-BIG-TRENDS. That number up there is, just remember, 1-800-BIG-TRENDS on your phone, and that'll get you to us, and we can answer any questions you might have. Let me see if I missed any other questions before we wrap it up, because I'm already over. Bull for now until 2016 elections happen, says Pete. It's interesting. If you look back on that, Pete, it was bullish about midway in election years, and then the last couple of, especially 2 term presidents, 08 and 2000, the second half of the election year was not so hot. In fact, it was a great opportunity to cash in on some big time puts. As I said, I called it out in Barron's in September 2000. Watch out below, and the market tanked on the whole, Bush Gore, Florida hanging Chad fiasco. But it was more than that. It was that we were unwinding that prior bubble of bullishness, and then same thing in '08 as we unwound that whole financial and real estate bubble, and then it all cratered. There's a lot of opportunities on the upside, but there's also a lot of opportunities on the downside. I'll definitely teach you how to take advantage of both. Okay, it looks like I answered all the questions. You can call Chris at our 800 Big Trends line or go to that link right now, bigtrends.com/top3bootcamp. Top and then the number 3 and then bootcamp. And then we'll stand by to answer any questions through 800 Big Trends. I'm out of time. I want to hand it back over to the good folks at Cyber Trading University so I can wrap it up and say have a great evening and get started learning these big trends approaches. I'm extremely confident it's going to open your eyes to a whole world of opportunities you've been missing out on. So definitely take advantage of it and call us at 800 Big Trends if you have any questions. Back to you, Jesse, and thanks so much for hosting today.